Okay, welcome everybody. Thank you so much for joining us. I've been excited about this webinar ever since Bryan Maddex agreed to do this for us. I think this is incredibly timely in terms of the content. And so this is Opportunity of the Decade, Purchasing Real Estate in the Wake of COVID-19. I'm Sean McKay with American IRA, and we are very lucky to have with us Mr. Bryan Maddex from Amerifirst Home Mortgage. Bryan, thanks for joining us, buddy.
Always my pleasure, Sean. Thank you for having me.
Absolutely. So, in terms of the structure of the meeting today, I'm going to try and keep our self-directed part to, frankly, just a short commercial, so that we have as much time as possible for Bryan to dig into educating us on different loan products and how we can think about making some investments. More than anything, I just want to communicate. Again, this is timely content. However, this is not necessarily self-directed IRA specific today. I think it's just overall great investment knowledge that Bryan's going to be able to share with us in terms of how we can utilize different loan products, frankly, largely outside of our retirement accounts, to build that long-term wealth with rental properties and those sorts of strategies. So Bryan's been an incredible resource for me in my investing. I've known Bryan. He's been a good buddy of mine for probably 7 or 8 years now. Wealth and knowledge, just a really, really solid guy. And so I can't think of anyone better to educate us on different loan products. So as I mentioned, this is a really unique time for those of you listening to this live. I love this quote that's attributed to Mark Twain, excuse me. History doesn't repeat itself, but it often rhymes. So as I think back to the '08 crisis, certainly there was a lot of financial pain for a lot of people, and that's obviously incredibly unfortunate. But certainly for those of us that are investors and we're looking for opportunities to allocate capital to grow wealth, I have zero idea what the next 12 to 24 months looks like for our country. That's well beyond my scope of capacity to analyze that. But what I can say is that ultimately there are opportunities. We're seeing clients doing a lot of interesting deals right now. They tend to be getting deeper discounts than they were previously. And so there's just going to be a lot of opportunity for us as real estate investors to work with burnt out landlords, to work with homeowners that need to move for different jobs and what have you. So again, really timely that we start discussing this type of content. So at American IRA, we're a self-directed provider, and ultimately our role is to allow individuals to use their IRAs or 401ks to invest in opportunities such as not only stocks, bonds, and mutual funds, but investing in alternative assets such as real estate, such as being lenders to other investors, investing in privately held companies. And we're based largely out of North Carolina. So our headquarters is in Asheville, North Carolina, and we have satellite offices in Charlotte, North Carolina, as well as Atlanta, Georgia. So we have a footprint in the Southeast, but we do have clients nationwide. And again, today really isn't about us, so I'm just going to kind of run through this very quickly. So as we're thinking about real estate, presumably if you're listening to this recording or you're on here live, you're largely interested in making real estate investments. So as it pertains to your self-directed IRA or 401k, keep in mind that any type of investment strategy can be utilized with your self-directed account. So you can do anything from purchasing rental properties to fix and flip deals. If you're working off-market deals, you can certainly utilize options and wholesaling techniques. I believe Bryan's actually going to talk a little bit about some of the interesting ways that private lending can be a part of the story to ultimately end up with some great conventional loans that he'll be discussing. So there's a lot of different utilizations for these retirement accounts, even in the self-directed world. So as you're thinking about acquisition strategies for these retirement accounts, to me, I break it down into three fundamental categories. The first is most typically our clients will just simply have their IRA or 401k simply pay cash for an asset. such as a rental property, for example. Very easy, clean, vanilla deal. The second opportunity is where the IRA or 401k actually partners either with other retirement accounts or individuals or companies to acquire an asset, again, such as a rental property, make a loan to an investor, etc. And then the third opportunity is for the IRA or 401k to borrow money for the acquisition of an asset, such as a rental property. Now, the key there is that it needs to be a very specific type of loan called a non-recourse loan, where you as the account holder are not personally guaranteeing the debt associated with that acquisition. And we certainly have a lot of content we've created where we delve into these options and different ways to work through these acquisitions. But again, today really is fundamentally about Bryan sharing with us the different loan products that as investors, largely outside of our retirement accounts, we can utilize to create some great long-term wealth. So Bryan, if you can give me a moment, I'm just going to go ahead and if you can test that and see if you can take control of the mouse and what have you.
Am I on?
You're on.
All right. Well, I think I owe you some money for saying some nice words for me at the beginning of this. Thanks, Sean. And in full disclosure, I do also have accounts with American IRA and use their services and love it. So thank you for all that you guys have done for me personally investing. It's been a great mutual relationship for years and years, which is fantastic. So I'm Bryan Maddex with Amerifirst Home Mortgage, and I've got a nice sized team, and I finally created a logo, and it's not a house that is a calendar. I heard if it was a house that has compliance issues, but that obviously is a calendar at the top left-hand side, so full disclaimer. Now, I'm going to go over a whole bunch of different fun things and kind of some of the hacks that I have found that work in the real estate and the mortgage world. The mortgage world we're going to discuss has gotten pretty simple with all of this news, and I'll kind of explain why. And to really understand where we're at and why we're here, we're going to go over, see if I can get this to go forward. We're going to go over how this is an opportunity of a decade and how you can still buy real estate with COVID-19 out there. So today what we're really going to look at is kind of first a market update, understand where we are and why we're here. And then two, we'll go over kind of the programs that still exist and how you can use those with your real estate investing. And part of real estate investing, you know, listen, a lot of us flip houses and sell houses, and we need to understand what our buyers have access to now that might be different as well. And then objective three, how to finance more units. We'll get into that. And then the bonus, this is to keep everybody attentive throughout the whole presentation. How to buy unlimited homes with 3% down, and how to do 100% financing on investment properties. So that hopefully will whet your appetite just a bit and keep you engaged. So headlines. Today, another 3.5 million unemployment claims were filed. So we have 33.5 million unemployment claims. And when you look at the mortgage world, that headline has changed a lot of perspective. And we've got a lot of lenders making major moves because 6 weeks ago, listen, there wasn't 33 million people unemployed. There was a couple 100,000. I think it was like 700,000 or 800,000 people were unemployed 6 weeks ago. And so this has been a major, major change, and very quickly. With that change, when you've got people that are not working, and a lot of those people are getting access to some government money, but a lot of people aren't. There's a lot of people that are stuck, and I talked to a lot of real estate investors who, you know, there's no special programs for that real estate investor who has 5 or 6 properties, right? So you may have people not paying rent, or you may have people that are unable to pay the full amount of rent, and there's no extra help. But we've seen 6.99, this is as of, I think it was as of last Friday, 6.9% or 3.8 million mortgages were already in forbearance. There is a disproportionate number of those that are Ginnie Mae, which is your government loans, your USDA, VA, and FHA loans. 10.45% of those are in forbearance. And that is a staggering number. I want to say the $3.8 million or 3.8 million mortgages is something like $800 or $900 billion worth of principal balances in mortgages and forbearance. So how else is that affecting us right now? Home listings has dropped, right? So if you look at the year over year numbers, I think at the bottom, home listings were about 44% lower this April than they were last April. And we already had in the Charlotte market and in many markets across the nation, some of the historic lowest levels of inventory out there. So finding houses to buy is a little bit more difficult right now on MLS. And you've got some major lenders restricting guidelines. Movement Mortgage, Chase, Wells Fargo, a lot of lenders have either cut off their government lending programs altogether. Basically, there was a liquidity crunch, right? So people know how to trade on the stock market, and they know if they've got stocks in the stock market, you can borrow against your own assets, and you can do margin trading, right? So you can take your investments, borrow against them to buy more investments, and then you can borrow against that and buy more. Well, when the stock market dropped 30%, there was margin calls. And when those margin calls happened, people had to sell everything. They sold their gold, their Bitcoin, their stocks. They sold anything they could get money for to cover those margin calls. And when that happened, people stopped investing in things they used to invest in. And one of those major assets that people used to buy a lot of was mortgage-backed securities. And so the mortgage-backed security market got crazy. And nobody is buying government loans. If you see the stat three lines up, 10.45% of government loans are in forbearance. That's why nobody's buying them. It's a very, very risky investment to make if that is highly likely to go into forbearance. So you've seen a lot of lenders just flat out refuse to do new applications. We had a lending partner, TFC Bank, that stopped doing HELOCs. Chase and Wells Fargo have stopped doing HELOCs, home equity lines of credit. Chase has raised their minimum credit score to get a mortgage at 700 with 20% down. So they just stopped doing any low down payment assistance programs that are out there. And we're going to continue to see some additional pullback for the marketplace. The other thing, and I didn't put us on the slide, is all of the creative products, the non-QM products, those are the things that aren't Fannie and Freddie. So you've got your bank statement loans, you're one day out of bankruptcy. You had investor cash flow loans where you didn't need to show income. You just had to get a loan based on the projected rent of your subject property versus the projected payment. We didn't look at any other income for investors. Most of those programs don't have any liquidity and they have stopped. So I lost, I think, 3 different investors who were buying those things. So I can't do any of that creative fun stuff anymore. Will it come back? Eventually, but who knows when? So let's go to some good news, right? So we always look at how do we flip that. Mortgage rates are the lowest levels ever per Freddie Mac. I think last week Freddie Mac said the average interest rate on the mortgage was 3.34% or 3.36%, which was the lowest average since they've been tracking interest rates. FHA, VA, Fannie Mae, Freddie Mac, USDA, they have had no changes in policy. They have not restricted their guidelines. They've not changed their reserve requirements. They have not done anything to restrict access to money. So that's a big difference right now from what we had in 2008. 2008, it was very difficult to get a mortgage. I wasn't actually in the mortgage business. I was in the banking business, and we had guidelines changing every week. The mortgage business, we're not seeing that. In fact, we're seeing the opposite. Appraisal requirements, because people don't want other people in their houses, they have become relaxed. So there's often times now where we can do an external only appraisal, or we can do a drive-by appraisal. And Fannie and Freddie have just extended those guidelines to the end of June. So if you've got a seller who doesn't want people in their house, or you've got an appraiser who doesn't want to go into people's houses, we can still get those to appraise and we can still get transactions to happen. Fannie and Freddie want to be doing business, and they're trying to make it easy. The only guidelines that have changed come to verification of employment. So everybody is now requiring us to re-verify employment right before closing because 33 million people are now unemployed, and they want to make sure you still have a job right before closing. So that guideline has changed, but that's not a credit guideline. It's not a debt-to-income guideline. So you're able to still get a mortgage just as easily as you could prior to COVID. And as of last month, houses were still appreciating. We saw a 0.5% appreciation the last week of April for average homes. And the median listing prices was up 4.4% in April. So I found an article on Zillow, and I copied, I'll credit them. This is a Zillow slide here. But they are predicting that we will see home prices fall coming into the end of this year, but they expect them to rebound by next year. So we haven't actually seen this start to happen at this point, but that's some of the projections. And I didn't want all the good news to sound like it's not going to happen. We may start seeing some values decline. In Charlotte, Sean, I'm still seeing people listing their houses on Friday, getting under contract on Sunday, having multiple bids. Are you seeing anything different out there?
I agree. I think the one thing that we've already seen is that, as you said, the unemployment rate and just individual situations, there's a tremendous amount of off-market opportunities for us as investors where we're seeing clients that are once again able to buy that $200,000 house for more like 140 or 150 as opposed to 190. So yeah, I agree with you.
Yeah, I don't know that we're going to see a lot of drastic things. You know, the CARE Act, one of the things they're trying to do, and we will stay very far away from politics, but one of the things the CARE Act is trying to do is keep businesses in business and homeowners in homes. So there's a lot of stimulus. I think the number is up to something like $3 trillion if you add in all of the government buying of bonds and things. They've spent like $3 trillion trying to keep money flowing and keep business happening. And with that level of support, we're not going to see, I don't think, and again, like you said earlier, 12 to 18 months, this whole world might look a lot different than it does today. But the goal is that we don't have a 2008 scenario where we have a huge, huge number of foreclosures, but all of these government programs have a way in, and not everybody's going to qualify. Not everybody's going to know how to participate or to file for that help. And we're going to see a lot of changes in the forbearance process. You know, so forbearance, if people don't understand what forbearance is, it is not a skipped payment. It is a delay of that payment. So if you go into forbearance for 3 months and your payment is $1,000 a month, you can hold this month, next month, and the following month, that's $3,000. On month 4, as the policies are written today, when you come out of forbearance, you owe 4 payments. You owe $4,000. Now, there's a lot of talk about the GSEs, the investors for all of these major, FHA, Fannie, Freddie. There's a lot of talk about actually moving the policy to allow it to be a true skipping of that forbearance money. But right now, it's due. That's how the forbearance is written. There's a lot of pressure for them to change that. So we may see some people that they can't catch up and they can't modify and they don't qualify for the support. So we may see some fallout. But for people that are selling houses and for people that are buying houses, the drop in interest rates is tremendous. You know, a 1% drop. So I would say beginning of this year, we were in the low 4s on interest rates. And right now we're in the low 3s. That's a 1% change in interest rates. So I found a quick article. The New York Times actually published this with Redfin, and they just showed if your monthly payment's $1,000, they make some assumptions on what taxes and insurance are, and they make an assumption that you're putting 20% down. But on a 30-year mortgage, $1,000 monthly payment buys you a $17,500 bigger house for the same payment. So we do have some increased buying power with these reduced interest rates. And this goes on the investor side too. We had gotten interest rates up to about 6.25% at the highs for investors if you weren't putting a lot down and your credit scores weren't perfect, or you had a small mortgage. And right now, those interest rates are lower. We're seeing many people in the high 4s or the low 5s on interest rate. That means investors can go buy more house, or the houses they do buy are going to be a little bit cheaper. So the cash flow could hopefully be a little better. So I wanted to kind of go over what the guidelines are for the main programs that exist still. So if we take out all of the non-QM, all of the fancy and creative things that used to exist, which there are still some active programs out there, it is just very, very limited. And some of those programs are here today, but they may not be here tomorrow. They may not have been here last week and they got a little money and they're going to fund what they can until they run out again. So the liquidity issues have not majorly changed, but Fannie and Freddie guidelines are all the same. So investors, 620 is the minimum credit score. And I'll be the first to tell you that if you're putting only 15 or 20% down, you're gonna have a hard time getting an approval with 620 unless you have a lot of reserves and you have a very low debt to income. That's when Fannie Mae is gonna give us an approval in the lower credit scores. So for my average investor, we really need a 660 to 680 to get an approval, but the minimum guideline is a 620. Fannie and Freddie both let you do 10 mortgaged properties. And that is an important way to view that guideline. It is 10 mortgaged properties, but a mortgaged property could have several units. So if you financed 10 quadplexes, that's 40 doors, 40 units. Full doc, everything, pay stubs, W-2s, tax returns, everything's on the up and up and above board. We got to look at them bank statements. We got to see where the money came from. You can't get gifts when you're buying investment properties. It's got to be your own money. You can do a loan against your own 401k. You can do a loan against your own assets. So you can do a home equity line of credit. You could do a cash out refinance on a property you own and use the funds from that to buy another property. So we can document a lot of different types of money. It just has to be your own. It cannot be a gift. And it has to be seasoned for at least 2 months. So if you did get, a loan from a buddy, and you're not going to tell the bank that you got that loan from the buddy, which I don't encourage because that's mortgage fraud. We always ask, do you owe any money outside of what's on your credit report? But you would want to have that money in there for 2 months. Maybe you have an investor, a partner who's not going to be on the mortgage. We would look at that as a gift. So if that investor or partner gave you that money at least 2 months before you did the application, that would be one way to use that money. And you can still do 15% down. If you own less than 4 mortgaged properties, Fannie Mae will let you put 15% down. There is PMI. It's usually pretty cheap. PMI has gotten a little bit more expensive recently because unemployment is up, so there's more risk. And then PMI is an insurance, private mortgage insurance, which is risk-based. So there is a little higher risk right now, so that PMI is slightly more expensive. But you could put 20% down to avoid PMI. And anytime you're doing a refinance on a single family property, 75% is the max loan to value. If you're doing a cash out on a multifamily property, 70% is your max. And anytime you're buying a multifamily property, 75% is your max loan to value. So there are some very general guidelines for investors to go get, and I always call Fannie Mae money the golden standard, right? It's 30 years, fully amortized, no balloon payments. It's the cheapest interest rate you're going to get. You can find alternative sources of funds, but it's typically not going to be fixed for 30 years. It's typically not going to be at the same low rates that Fannie Mae is going to have. And it may have a balloon payment or a shorter amortization term. So you can get things outside of Fannie Mae, but Fannie Mae, if you can qualify for that, it's going to be the gold standard of the money out there.
So Brian,
what about your homeowners?
I'm sorry, Brian, could you unpack just a little bit more? So when you're speaking about the 10 finance properties, so let's say that an investor has, we're kind of hitting that 10 finance property mark, but let's say a portion of that portfolio is, let's say, seller finance properties, and the properties were purchased in the name of an LLC, and the managers, the members, they did not personally guarantee the loan. So this is truly a commercial type of loan. Would that count against the 10 finance properties?
No, that's a great question. And that's a great way to structure some additional finance properties. If the asset or the house and the loan are both in the business name, Fannie Mae does not count that as you owning or being responsible for that property. Now, an underwriter can always ask for a copy of that note. And if they ask for a copy of that note, what they're going to look for is, are you a personal guarantee? So you might have gotten a blanket lien from, let's say, BB&T or whoever they call themselves now, Truist. Let's say you got a blanket lien on 5 properties, and that blanket lien was in your business name, and those 5 properties are now also tagged or titled in your LLC. Those 5 properties are not going to show on credit. They're going to show on your tax returns as owned by the business. So you'll see a Schedule 8825. And we should not ask if they've been on tax returns. We should not ask for the notes. We don't care. Now, if you are a personal guarantee, again, on the application, you're supposed to say, are you liable for any additional debts? You should check yes. But maybe you forgot, or maybe you're not a personal guarantee. Those don't count against you. If you are a personal guarantee, those technically do count against you. Or if that mortgage is in your name, but the loan or the house is in your LLC, that counts against you. Or if the house is in your name and the mortgage is in the LLC, that also counts against you. So it's got to have both the house and the loan in the LLC's name, and technically you not being a personal guarantee. And then those do not count against you.
Great, thank you.
It's a great question. Yeah, so homeowners, they have a little more flexibility. So if you're flipping or selling some of your properties, you want to know what your homeowner can get. A lot of banks have said FHA raised their minimum score to 680. FHA did not raise their minimum credit score to 680. The bank has an overlay which has raised the minimum credit score to 680. So don't misinterpret that. If you hear someone say, oh, FHA changed their guidelines, I don't qualify anymore, they need to find a new lender, not a new loan program. So FHA and VA both can go down to 500. It's hard. Down to 500 is very hard. I have done several. And you basically need good liquidity, good reserves, and low debt to income. But, you know, bad things happen to good people. So sometimes there are things that can bring a good person's credit score down. So we don't judge. We just try to find a way. You do need to put 10% down on FHA if you're under 580. So it's more difficult, but it's certainly possible. The same minimum credit score for conventional loans exists for homeowners, 620. Again, it's going to be hard for a homeowner. Between 620 and 660 or 680 could be very difficult for a conventional approval. You can always buy a house as a primary residence. So if you're an investor, Sean, who has 10 financed properties, but you're moving your family into a new home, you can go get an 11th property under Fannie Mae. It just has to be your primary residence. So there is one way to go get some additional financing. If you're single, you don't have kids, and you can move every year, you can add as many principal residences as you want. Your mortgage guy might not like you because it's a lot of work. Unless they did the last one and they have all the docs and they can just keep going. I actually love working with investors and doing a second, third, or fourth property because it's half the work. USDA and VA financing both offer 100% financing. Conventional loans, if you are a first-time home buyer, you can always do a 97% finance loan. If you're not a first-time home buyer, there is a program called Home Ready or Home Possible. Freddie Mac has Home Possible. Fannie Mae has Home Ready. Those are income limited programs. In the Charlotte region, it's about 60 grand, and you can do 97% financing. Otherwise, if you're not a first-time home buyer, or you make more than the Home Ready or Home Possible income guidelines, you'd have to put at least 5% down on conventional. And FHA is not a first-time home buyer program. A lot of people ask, oh, I had an FHA loan before, I can't get another one. You can have as many FHA loans as you want. You just can't have two at a time, unless you qualify because you moved for work or your household size changed. There's a couple exemptions to the two at a time rule. But FHA is always 3.5% down. You see any questions on there, Sean?
No, I love that idea that you can keep buying new primary residences. I think that's really strong.
Well, we're going to hack it up in the next slide. So I told you guys that the interest rate per Freddie Mac, I'm not allowed to say interest rates are lowest of all time. I'm not allowed to say that. That's a trigger word, and I'm not allowed to advertise that. But I can tell you that Freddie Mac said it last week in an article. So you can go Google Freddie Mac average interest rates, and you'll find that news article. So they said that it is the lowest rates of all time. So I'll show you a couple of things that I have very recently locked. So I am doing a rate and term refinance for an investor. His interest rate is going to be 3.875%. I just locked him yesterday. Sean, 3.875% is the rate that I have on my current primary residence mortgage, and I'm giving that to an investor. Is that crazy?
That is absurd. And can you just unpack for us the rate and term concept so that we're all kind of tracking?
Yeah, that's great. I always assume everybody knows everything I do, but that they may not. So you have primarily two types of refinances. You have a rate and term refinance, meaning I am just changing my rate and term. I am not taking out new cash. A rate and term refinance means we are paying off another mortgage and we are going to get less than 2% or less than $2,000 in cash in our pocket with that refinance. So if you're doing a $100,000 refinance, you can actually take out $2,000 and put it in your pocket. It is still considered a rate and term refinance. You can also pay off all your closing costs, and you can pay off all the interest due on the loan we're paying off. So Sean, if you had a hard money loan that was no payments until payoff, you might have 7 months worth of interest that have accumulated. You can put that all in the new loan. And you can put the closing costs for the new loan in the new loan. So you could do a refinance with no money out of pocket and possibly put a little bit of money in your pocket with that refi. A cash out refinance is anytime you're doing a mortgage on a property that you don't already have a mortgage on. That is considered a cash out refinance. Even though it didn't have financing, it is still a refinance. I don't make up those terms, but that's how it is. Or if you're taking more than $2,000, if you take $3,000 out, that is a cash out refinance. So most of the time, if you're only going to get $3,000, let's just drop it to 2 and save you some interest rate. So for this investor, he was doing a rate and term refinance. I think the loan size was $180,000. He had over a 740 credit score, and we were not taking out cash. And I locked him in yesterday at 3.875. Pretty crazy. I've also locked a purchase, an FHA purchase, at 2.75, and that rate had a 1-point lender credit towards closing costs in the rate. There was extra profit in the rate. That is crazy talk. So if you think inflation on average is what, 3.5? If your mortgage is under the inflation rate, to me, that mortgage is free. That's a free mortgage. I've locked a conventional loan with 5% down, owner occupied 3%. So I would tell most clients, they ask me, oh, what are rates today? And I say about 3 to 3.25, depending on your credit score, the loan size, and how much you put down. And then the worst rate on my rate sheet for investors is 5.5. The worst rate on the retail side for government loans is 6.5. But 5.5 is the worst rate I can offer today on a refinance. All right, this slide. Oh, it got fancy. I didn't know I had to click on, I must have done that on accident. How do I finance more than 10 units? Sean, 10 mortgage properties, how many units can you have? Pop quiz.
Up to 40.
There you go. You have been paying attention, my friend. So you can finance more units by just buying multifamily properties. Sean, can I do a 5-unit property?
I don't believe with your product, can you?
No, I cannot. I can do 1 to 4 family homes. I set you up on that one. I can do 1 to 4 family homes. And me being the whole mortgage industry, so a retail mortgage, Fannie and Freddie, that is it. 1 to 4 family homes is the max. So you can, I actually have financed 2 duplexes on 1 lot. So the 4 unit doesn't have to be connected. It can be 4 individual units on one lot. That could be a multifamily home. 5 units would be commercial or private or hard money, something that's not me. So one thing you could do, Sean, is you could refinance property A and pay off property B, and that frees up 1 more unit or 1 more property that you can go finance. So I think, Sean, tell me about 1031. That could be very similar, right?
Yeah, so Bryan has been a resource for us for a number of years now, and we've done, frankly, over 10 loans with Bryan. And so one of the tools that we've utilized is we will have a property that we call it Maddex money on initially. So property A has and then we decide we're looking for additional cash flow. So we might 1031 property A into property B, which is either a single family home that's renting for more or in a better neighborhood, or somehow we find it to be more desirable, or we exchange into a duplex, triplex, something like that. And then the property B will typically also have Maddex money on it as well. So we're able to keep the same amount of loans, but maybe increase our cash flow position, number of units, equity, whatever it may be. So we love that.
Yeah, the 1031, there is no extra work on the mortgage side. Not a lot of mortgage people have interacted with 1031s, but the 1031 literally is just your down payment money. So we have to really work the numbers to protect how much money needs to go into this property, because we don't want to leave any 1031 money on the table. That could be a taxable event. So it is kind of tricky when you're putting down payments and putting closing costs in and doing the math on the 1031, but it's no extra work. There are no extra guidelines. It's very easy to interact with traditional mortgages and 1031s. Sean, did you know, I think we covered it in the last slide, but did you know that you can always buy a primary home?
Yeah, that was something I didn't know. Well, a number of things I didn't know prior to meeting you, but yeah, I'm trying to make sure my wife isn't aware of that, because I'm lazy and so please don't tell Heather.
Well, it is so important that you read that I put it on here again. So I said, read that again. you can always buy a primary residence. So what is a primary residence, Sean? A primary residence is when one of the occupants that is on the mortgage will live in the property for at least 12 months. So do you have a nephew or a niece or a close personal family friend that you could put on a mortgage with you? They don't have to have income. They don't have to have credit. They can have no credit. They could be 18 years old. They could even be in high school. Literally, if they're 18 years old and in high school, they can be on a mortgage. There's nothing that says they cannot do that. And you could go buy another primary residence with that person, nephew, niece, son, anybody, right? And it's no problem. Now, the slide, I was really poor in building these slides and then account for just screen sizes, so I can't see the bottom of this slide. But I put back on here that 97% financing for first-time home buyers is always available. So, Sean, as an investor, when you buy an investment property, you have to put down at least 15%, usually 20%. But if you're buying a primary residence, you can do 3% down. There's PMI. But that's 3%. That's if you just take 20 grand, you could buy one investment property or four, depending on the price of the house. If you put 4 people on the loan and they're going to live in the house for at least 12 months. So there is a way to get unlimited properties using Fannie Mae money. Not too shabby. All right, so there's how you get unlimited money. Oh, by the way, interest rates are always better on primary residences than investment properties. So there's that too. All right, Sean, let's go into BRRR. Buy, rehab, rent, refi. And I put a star on rent because everybody thinks the house has to be rented, and it doesn't. We can use future rental income when we are doing Fannie Mae and Freddie Mac loans, as long as you're an experienced investor or you have housing expenses already, meaning you already own a property. So we don't have to have it rented. We can actually give you future rent. We can give you 75% of the market rent analysis. So it's going to be on an annual lease. That won't work if you're trying to do like an Airbnb type thing. But the traditional BRRR financing, if you find a house, you have to put down at least 15%. You rehab that house with your own dollar. You call me 6 months later because there's a 6-month seasoning requirement before you can do a cash out refinance. So in 6 months, you call me and you say, hey, Brian, I bought a house. I put money into it and I want to refinance it and get my money back. Great. Got to wait 6 months. That's traditional financing. Here is how hard money can help, or private money. So if you've got somebody that you know, maybe with one of them American IRA, self-directed IRAs, they can lend you 100% of the purchase price and rehab money if the lender will let you. You've got to negotiate it, right? So when you get outside of Fannie Mae is very structured and the guidelines are very specific on what's allowed. But when you're negotiating with somebody that has IRA money, you get to decide what the terms are. You're the lender. If you own that IRA, you can decide if you'll do 100%. Do you know who you're lending to? Are they trustworthy? Are they getting this property with good equity position? Is there a lot of risk if you finance 100% of their projects? Do they have a track record? So you got to decide if it's worth it, or you got to find a lender that will let you finance with 100% lending. Some may want 5 or 10% of your own money into the project just so you got some skin in the game, but you could get 100% loan on the purchase price plus the rehab. And then there is no seasoning requirement to refinance that loan because it's not cash out. We're doing a rate and term. So depending on the hard money lender, you may be able to pick up a rental, a long-term rental, with no money out of pocket. You could finance in all the closing costs, all your renovation costs, even all of the interest. If you don't have to pay interest on that loan, you can finance in all the interest that it took to get that hard money loan into your new long-term loan. So the downside, you have to do 2 closings. You got to close once with hard money, get the work done, and then I refinance afterwards. So let's look at those 2 on a $90,000 purchase. So traditional financing, you come to me and you say, Brian, found a house, 90 grand. Great, you need 15% down, that is $13,500. Your rehab budget's 25 grand. Quick math on that, Sean, is what? $38,500. So you're out of pocket $38,500 for 6 months. And then you come to me and I can refinance it. A cash out refinance, higher rate than a rate and term refinance. So we can go put long-term financing in place. But if you bought that same house and you got your initial loan to be $115,000, you're no money out of pocket. As soon as you're done with the rehab, we can refinance that into long-term financing. We use the new appraised value right away. Since there's no cash out, there's no 6-month guideline, there's no 6-month seasoning. So that, my friend, is how to buy an investment property, 100% financing.
To me, that's worth the webinar right there. That has been such a strong tool. We've seen a lot of investors in town utilize this based upon Maddex essentially coaching me up on this. My wife and I have utilized this a number of times as well. I think this is so strong, as you said, to be able to use that initial private money on the front end, hard money, whatever you want to call it, wherever you get it from, whether you're making payments or not, you're saving yourself so much money on not having to put that full 15, 25% down payment if you don't have to, if you don't have it, et cetera. So very, very strong tool.
And there is a downside to this, Sean, is you've got to get the project to appraise, right? My max loan to value is 75% when you're finished. So this isn't going to work on a lipstick transaction, right? If that 25 grand is paint and window treatments, probably not going to give you enough value to let you realize a refinance with no money out of pocket. So you do got to keep that in mind. It's got to appraise at the end of the deal.
I would respectfully disagree because obviously you're the expert on the lending. What I will tell you is we were very fortunate to get, in one specific situation, a deal from a wholesaler in town, and they were willing to sell it to us at such a discount that even frankly doing the paint and carpet, we were able to get a reasonable value from that appraiser. The caveat to that being, I agree with you, that's tough for appraisers. We did actually have a conversation with that appraiser. They were challenged by the fact that I believe in this situation we had purchased it for 70-something thousand. And we believed, and they ended up agreeing ultimately that the property was actually worth about 120,000. And so it definitely is a conversation that would need to be had with the appraiser, because they're not necessarily going to be familiar with off-market transactions, wholesale deals. Wait a second, I saw that this was just closed for X. How can you tell me it's worth, plus 30% equity, et cetera? So it can be challenging, but I can just tell you that we have done that with your loan product on a very minimal rehab to rent situation.
That is perfect. If you're buying retail, it's going to be difficult, but if you're buying wholesale or you find one of those off-market deals, it could happen. But it is, to your point, it is going to be challenging. Some appraisers are just going to be against, hey, this house is not worth X dollars more just because you put new carpet into it. So if you can convince your appraiser and have those logical conversations, and you got to be careful what you say to appraisers. There's a lot of things you can't say, but you can tell them how you bought it and how you were able to save somebody from losing their house, or why it was discounted and why it's not really worth what you just bought it for. But those are going to be the more difficult ones to appraise. So just be cautious, and certainly if you can buy a house right, then you've got some opportunity there. So there's my contact information. I am going to be on webinars today until about 2:45. So this afternoon or tomorrow is going to be best to try to contact me. If you've got any questions, you can do an application at maddexteam.com. That's my cell number on there. And I would be very open and welcome to any questions that people have at this point.
Perfect. That was an incredible amount of content. Really appreciate that. So again, as Maddex said, as Bryan said, he actually has another webinar at 1:00. By my time, we're at 12:45. So for any of you listening to this live, certainly feel free to type into the questions box, and we'll ask Bryan to stay on till, we'll call it, roughly 12:55. And again, a lot of great information there, a lot of good gems. So again, Sean McKay, American IRA. Obviously, the star of the show is Bryan Maddex, Amerifirst, home mortgage. His contact information is there. Let's see what we got. Okay, so we got quite a number of questions. So
awesome.
Okay, a lot of just overall positive feedback. All right. All right, here we go. So I was trying to buy a house with subject to mortgage. What's the implication of using a Roth IRA? Will that trigger UBIT? So ultimately, subject to your buying, or in this case, your Roth IRA is buying a property and keeping the existing financing in place, you're buying it subject to the existing mortgage. Great question on UBIT. So specifically, that would fall under the UDFI category, unrelated debt financed income. Please feel free to contact us offline and we can get into the specifics. But long story short, a levered deal where it is not the original purchase price money and it's not a solo K that is buying that deal, there is a potential for a tax consequence, which is UDFI. Ultimately, your CPA is going to be the best resource to identify if there is a paper gain at the end of the year. I've certainly found, and Brian's seen looking at my tax returns, that I most definitely have paper losses for all of my rental properties. Sometimes real losses with my rental properties. So what we find is most of the time after the deductions that you can take with your IRA acquiring a property with debt, there does not tend to be a net paper loss, which would constitute a possible tax situation. Great question, but definitely feel free to contact us offline for that. Okay, some more good feedback. All right. So Brian, the question is, what is available today if one doesn't have full doc, such as pay stubs, W-2s, and or returns?
It's much more limited than it was 2 months ago. So a lot of those fancy or alternative loan products or the non-QM world, a lot of that got shut down with the lack of liquidity and nobody is buying that investment paper anymore. So I still get marketing from a couple of people and I hear a couple of people that are still lending. So Carolina Hard Money, I have heard, is still doing some lending. Their guidelines may have changed. Lending One, I have heard, is still doing some lending and their guidelines and products may have changed. I haven't heard from a lot of other of those alternative lending sources, but you're going to look more for an asset-based lender. Fannie Mae and Freddie Mac, they are an income-based lender, so we do have to verify the income. Even if you got $1 million cash in the bank, that cash doesn't count and doesn't make the mortgage payments. Now, I'll tell you there is a trick. If you have $1 million in an IRA and you are 59 and a half, you can do a systematic withdrawal from that IRA and you can create your own income with that. So that's not going to be everybody if you're not old enough to do that, or if it's not actual, you don't actually have to be 59 and a half. It's just, you may have some penalties if you take that income, but you can take your own retirement funds and create income that way with assets. So that technically is an asset-based income stream. And those withdrawals just have to last at least 3 years in order for those to count. So there, you could do that. But outside of that, those programs are going to be a lot fewer and far between. And hopefully the market opens back up. You might find some people with IRAs out there that are fine to get 3, 4, 5% long term because they can't get that in the banks. So you may be looking at private money real hard at this point.
Perfect. Great. So there's zero chance we're going to get through all these questions unless we even at least attempt to do kind of a fire round. So Brian, if you're ready for this, a lot of great questions, a lot of interest, but all right. So first one is, if I have a spouse, can I effectively double the number of finance properties to 20 if I put 10 strictly in my name and 10 strictly in hers?
Absolutely, yes.
Perfect.
You just got to each qualify for those incomes. Yep.
Love it. Next one, does Fannie Mae loan to LLCs or only in a person's name?
They will only lend to a person's name. You can title it in an LLC after closing. My bank does not trigger a due upon sale clause as long as we document it. But if you do that outside of my company, you may have a due upon sale clause that gets triggered.
Yep, that's very easy. That's typically what we've done with Brian's loan products. So as you said, you shoot him an email. Hey, can we move this to the LLC? They document it. You document it. Good to go. What size loans are those rates for? Not jumbo, correct?
Yes, jumbo is actually another one of those product sets that is mostly dead. There are going to be some banks that have access to jumbos, but most of the brokered jumbo products all died with liquidity. So all the rates that I had, Fannie Mae in this area, the maximum loan size is $510,300, and FHA, the maximum loan size is $331,760.
Perfect. So this, I'm assuming, refers to your kind of creative primary home purchase strategy. Is it still legit if that niece pays you rent?
That is not legit because they are not owning the property. They can pay their portion of the mortgage. Mm-hmm. So I would say instead of having them pay you rent, have them pay part of the mortgage.
Perfect. And some of these are great questions, but they're kind of long discussion pieces. So apologies. We're just trying to make sure that we can get as many pertinent to this topic of mortgages as possible. So as I said, especially for the IRA-driven questions, definitely feel free to reach out to us. And we're happy to be a resource in terms of resources for finding hard money lenders and things of that nature. Short answer is if you're part of a local real estate investment group, that's a great place for hard money lenders and creating private lender relationships. Are there somewhat standard minimum loan amounts you see for a refinance on a BRRR?
Yeah, under $50,000 is very hard to finance with a Fannie Mae mortgage because the closing costs are such a large portion of the loan that they become illegal. So I would normally recommend people to contact a small community bank if the loan size is under 50 grand. My closing costs are the same on a $50,000 loan as they are on a $250,000 loan. The only fee that changes is lender's title. All the other fees are exactly the same on those two loan sizes. So obviously the percentage of closing costs to loan is very great at 50,000, and it makes it very difficult to make that loan legal.
Perfect. Okay, so we got some great feedback. We had an actual appraiser on the call live, so kind of a multi-parter, but I'm an appraiser. That should not be an issue with someone who has experience with doing investment properties. This is referring to the BRRR strategy that Brian was sharing with us. Follow up to that is give the appraiser a list of all the updates, but not what you spent. That's great feedback.
Right.
And the market should drive the final price, not what you paid for it. It's the appraiser's job to convince the lender that the market has driven the value. So really tremendous feedback there. We appreciate that, Mr. Appraiser. Okay, just trying to be, so 1254. So if you don't mind, just one or two more, depending upon the length of the response. Really great questions and feedback from everybody. We appreciate that. Let's see here. Can one entity you own lend money for hard money financing to another entity you own, then refinance that loan?
No, that is not going to be an arm's length transaction. So a non-arm's length transaction, which is to me, from me, we're going to look at the ownership and you're trying to get real creative, and creativity is not mixing with mortgage world. So I would say if you got to get creative, it's probably not going to work.
Okay, perfect. Awesome. Well, again, apologies. We weren't able to get through everyone's questions. Please feel free to reach out to the appropriate resource. We're all happy to help you. Again, Bryan Maddex with Amerifirst, you did a fantastic job just adding a lot of value today. So thank you, my friend, for sharing your wisdom with us.
Sean, it's always great to interact with you, and I highly encourage anybody who does not have a self-directed IRA, this is a tremendous time to partner with people. You don't have to be a real estate investor. I don't consider myself a real estate investor. I would rather partner with smart people, and that's why I have a self-directed IRA. But this is a fantastic time to have a self-directed IRA. Contact Sean, make sure you get one open. there's so many different ways that it can be very useful. So thank you, Sean, for all that you guys do and all the knowledge that you guys spread out with the great people you have on your webinars. You guys are awesome.
Awesome, man. I really appreciate that. And thank you all so much for joining us live and for your great comments and questions. And please let us know if you have ideas for additional content. Obviously, it doesn't necessarily have to be specific to self-directed concepts. We want to make sure we're just sharing as much quality information as possible, which this was absolutely that today. So we'll let Bryan go and get to his next webinar. So again, thanks for carving out some time for us, and we'll see you all in an event here soon. Thank you all so much, and have a great day.
Have a great one.